In the span of 48 hours, the silver market did something that's supposed to be reserved for once-in-a-generation accidents. On January 30th, 2026, silver recorded a plunge of about 27% in a single day. Not a slow bleed, not a multi-week downtrend, a trapdoor. Days earlier, it had been trading near a headline-grabbing peak around $121 an ounce. Then, almost as if the floor simply vanished, it tore down toward the mid-60s before the market could even agree on what just happened. And here's the part that breaks the way most people think markets work. The violent move didn't happen because everyone suddenly agreed silver was worth less. It happened because the market's plumbing was strained, leverage met friction, and the rules of engagement tightened at the worst possible moment. They said this couldn't happen in a modern, liquid, institutionally supervised marketplace, but it did. And when something impossible happens, it usually means the invisible constraints were more important than the visible story. Because while price was collapsing, another number was quietly rising: the cost of carrying risk. CME, the operator behind COMEX futures, lifted margin requirements on silver. For non-heightened risk profiles, the rate was raised to 15% from 11%. For heightened risk profiles, it rose to 16.5% from 12.1%. That sounds bureaucratic until you translate it. It means more cash demanded per contract immediately in the middle of chaos. That is how a market turns from volatile to violent. If you've been watching this channel for any length of time, you already know the rule. The headline is never the whole story. Welcome to Channel Name, where we don't chase headlines. We read positioning, plumbing, and stress points, so you understand the move before the narrative gets written. If you get value from the way we connect price action to the machinery underneath it, consider subscribing the way you'd keep listening to that wise elder who always seems to know what's coming. And while you're here, drop a comment with where you're watching from, because this market looks different depending on where you're standing. Now let's reconstruct what actually happened, step by step, like a forensic audit instead of a rumor. Late January delivered an accelerating rally that felt almost detached from gravity. The market pushed into triple digits and then into that shocking zone near $121 an ounce. Volatility expanded, but the crowd interpreted that as confirmation. Then January 30th arrived, and the market didn't merely correct, it collapsed. A 27% single-day drawdown is the kind of move that normally belongs to thin microcaps, not a globally watched metal. But price wasn't the only abnormality. The timing and the behavior were the signature. In a typical sell-off, volume rises as price falls, then stabilizes. In a liquidation, volume rises as price falls, then rises again as the market tries to rebound, because positions are being forced out on both sides. That is exactly the texture silver printed. A brutal drop, then an equally unnatural bounce toward roughly 78. The swing itself is the clue. Something was being unwound. At the same time, retail flows were moving in the opposite direction. Over the 6 trading sessions ending February 6th, about $430 million flowed into the SLV exchange-traded fund. On the crash day itself, January 30th, more than $100 million went in. Think about that contradiction. Price collapsing, yet a flood of money chasing exposure. That is not a unified market. That is 2 different markets colliding, one dominated by margin and collateral, the other dominated by narrative and timing. So the central mystery becomes clear. How can silver be crashing like a leveraged accident while retail money is rushing in as if it's a bargain? The answer is that demand is not the same thing as deliverable demand, and buying is not the same thing as holding power when collateral rules change. This is also where history stops being a textbook chapter and starts being a playbook. The silver market has seen this movie before, with different costumes. In 2011, silver ran hard, then experienced what many traders remember as a cascade of margin hikes and forced liquidation. The sequence mattered. Price rises, volatility rises, margin requirements rise, then leveraged holders are forced to sell into thin liquidity. The result is not a gentle pullback, it's a vertical drop. Go back further. In 1980, silver experienced an extreme rise followed by a dramatic reversal under the weight of concentrated positioning, financing constraints, and market structure shifts. The details differ, but the pattern is familiar. When leverage concentrates in a market that looks liquid until it isn't, the exit becomes narrower than the entrance. And now in 2026, it's happening again with modern instruments, faster flows, and deeper interconnections. In 2011, the story was about a commodity surge colliding with exchange risk controls. Result, a sharp drawdown that felt impossible the week before. In 1980, the story was about concentration and the limits of financing. Result, a reversal that rewrote careers. In 2026, the story is about volatility itself becoming the asset, and the rules tightening right as positions become most fragile. This is not opinion, this is pattern. Now we need to talk about the players, because silver is not moved by the market in the abstract. It's moved by institutions that manage risk, allocate capital, and enforce collateral. start with the exchange complex. COMEX futures are where a massive amount of paper silver exposure is expressed, hedged, and leveraged. When CME adjusts margins, it doesn't predict price. It changes the feasibility of holding positions. A margin increase from 11% to 15% is not a small tweak. It is a shift that forces participants to either fund more collateral or reduce exposure. Then there are the vehicles that translate narratives into flows. SLV is one of the most visible. $430 million in 6 sessions is a loud signal of attention. But attention does not automatically mean relief for futures holders. In a stressed market, the immediate pressure comes from those who must sell, not those who want to buy. Then there are the regional exchanges and cross-market positioning that most casual observers never see. One of the most striking episodes around this move involves a China-linked institution, Zhongkai Futures. Reports described it building a bearish position on the Shanghai Futures Exchange, with exposure equal to roughly 484 tons of silver, valued at more than $1.5 billion. And as the market unwound, that position was associated with profits estimated around $519 million. That's not a moral story, it's a map. When a player that large is positioned for downside into a volatility spike, it tells you the move was not simply a surprise. It tells you someone understood that the structure was unstable, that the rally had likely drawn in crowded leverage, and that a catalyst could turn imbalance into cascade. Next, consider the physical backdrop, because this is where people often get trapped in simplistic narratives. London Vault data from the LBMA showed silver holdings at end January 2026 around 1,729 tons, down about 0.3% month over month. That's a massive pile of metal sitting in the system, and yet the paper price was acting like scarcity one week and like panic the next. This is the dislocation. How can the system show large inventories while the market behaves like it's running out of oxygen? The answer is that inventories are not the same as freely available supply, and the location and ownership of metal matter. A vault statistic can remain large even while the marginal deliverable easily mobilized supply is tight. At the same time, paper leverage can expand far beyond what physical flows would justify. And when that leverage is forced to compress, the price can fall even if the metal doesn't vanish. This is where it gets interesting. The silver market has at least 2 realities running in parallel. There is the paper reality, where futures contracts, options, and leveraged exposure dominate, and where margin and collateral can change overnight. Then there is the physical reality, where bars and coins move through refineries, vaults, and regional demand centers. These realities usually rhyme. In a volatility regime shift, they diverge. On the paper side, the message was clear. Risk was being repriced. Margin requirements increased. Volatility exploded. If you were running leveraged exposure, your required capital rose exactly when your mark-to-market was collapsing. That forces selling even if your thesis hasn't changed. It's not about conviction, it's about survival. On the flow side, retail inflows into SLV suggested the story had captured attention. People saw a dramatic drop and interpreted it as an opportunity. But the market was not offering a simple bargain, it was offering a stress test. When retail buying meets institutional deleveraging, the price does not necessarily respond to the more buyers than sellers' intuition. The sellers are not choosing. They are being chosen. So let's lay out the evidence as a chain of numbers that cannot comfortably coexist. First, the price path, near $121 an ounce late January, then a plunge of about 27% on January 30th, then a rebound toward 78. That is not normal for a market that's supposedly deep and liquid. It is the fingerprint of forced liquidation and violent short-term rebalancing. Second, the collateral change. Margins moved to 15% from 11% and to 16.5% from 12.1% for heightened risk profiles. That is a direct increase in the cost of holding exposure. In plain terms, a trader or institution needed to post more money for the same position right when positions were hurting. Third, the flow contradiction. About $430 million into SLV over 6 trading sessions ending February 6th, including more than $100 million on the crash day. That indicates that, psychologically, a big group was leaning into the move, not fleeing from it. Yet the price still fell, meaning the dominant force in that moment was not discretionary buying. It was compelled selling. Fourth, the cross-market positioning, a bearish SHFE position equivalent to roughly 484 tons, with reported profits around $519 million. That suggests a large, informed participant not only anticipated volatility, but monetized it. Fifth, the physical baseline, 27,729 tons in London Vault. Data at end January, down only 0.3% month over month. To see how fast the squeeze happened, zoom in on the calendar. The run-up into late January didn't just lift the price, it changed behavior. Options implied volatility widened, which feeds directly into margin calculations and internal risk limits. Market makers, who normally provide a steady bid, and offer step back when the tape becomes disorderly, because the cost of being wrong for 10 minutes becomes enormous. Silver is uniquely sensitive to this because it sits at the intersection of industrial demand, investment narrative, and a market depth that's smaller than many people assume. The crowd hears precious metal and expects it to behave like gold, but silver behaves like a hybrid, part monetary story, part industrial commodity, part leverage vehicle. That hybrid identity makes it prone to violent repricings when the dominant participant changes from investor to risk manager. Now, consider what a margin change does in practice. A futures contract is standardized exposure. The trader does not pay the full notional value. They post a fraction as performance bond. That fraction is margin. When the exchange raises it from 11% to 15%, the required cash per unit of exposure jumps by more than 1/3. If a participant was operating near their limit, they suddenly have a choice. Post more cash immediately, reduce exposure immediately, or be reduced by the system as risk thresholds are hit. Here's the critical point. Forced selling doesn't wait for the bottom. It sells when the account cannot meet requirements. That means pressure can intensify at exactly the worst levels, creating the illusion of pure panic. It is not panic. It is a margin algorithm doing what it was designed to do. You can also see institutional fingerprints in how narrative and positioning diverged. Some commentary framed the drop as profit-taking, but positioning data suggested cooling speculation, 7,000. That's not a perfect map of every participant, but it's consistent with the idea that a crowded, leveraged trade was being reduced. Then there's the east versus west dimension, which is often misunderstood. It's not about one region controlling a market. It's about different venues expressing different incentives and constraints. When a major participant builds a bearish position equivalent to hundreds of tons on SHFE, while Western retail flows chase an ETF, you are watching two different risk languages in real time. Now layer in the physical conversation. The moment price collapses, attention shifts to whether metal is available, but availability is not a binary. There is metal in vaults, yes, and the London vault figure near 27,929 tons shows the system has scale, yet inventory can be earmarked, leased, pledged, or simply not moving at a price that makes sense to the holder. In tight moments, the marginal bar is what matters, not the total pile. This is the dislocation in plain terms. Paper can be oversupplied with leveraged exposure. At the same time, physical can be constrained in the channels that matter. The result is a market that can feel cheap to one group and unholdable to another. Historical parallels make this easier to see. In 2008, many markets became liquidity trades, assets sold off together, not because they were identical, but because financing and risk appetite snapped. In March 2020, similar mechanics appeared as volatility forced participants to raise cash. When you see January 2026's silver action, it belongs to that family of events. The market wasn't discovering a fair value. It was clearing an imbalance under stress, and the rebound itself is part of the evidence. After the plunge, silver didn't drift sideways. It snapped back toward the high 70s. That kind of reflex move usually means two things happened at once. The most urgent sellers were exhausted, and short-term liquidity providers returned once spreads normalized. But rebounds after liquidation are often deceptive because the system is still rebalancing. New margin levels have to be funded. Risk committees have to reset limits. Hedge ratios have to be rebuilt from scratch. This is why you'll hear experts disagree loudly after events like this. One group looks at the physical story and says, the metal is still here. Another group looks at the derivative story and says the paper structure just cracked. Both can be right simultaneously because they're describing different layers of the same market. In calm periods, those layers move together. In stress, they separate. Futures can gap while physical flows lag. ETFs can absorb buying while leveraged books are forced to sell. And when those contradictions show up at the same time, it usually signals a regime shift, not just a volatile week. Think of it like traffic in a city. On a normal day, the roads handle the flow. During a storm, a few closures turn small delays into gridlock, and then every driver's decision makes the jam worse. In markets, those closures are wider spreads, reduced dealer balance sheets, and higher collateral demands. Once the gridlock starts, price doesn't move smoothly. It jumps between pockets of liquidity. That's what violent volatility looks like from the inside. And silver, because it's smaller, feels every closure faster than gold by far. If those 5 points are true at the same time, then the only consistent explanation is a dislocation between the narrative market and the collateral market. And once you accept that, the next step becomes obvious. Understand the mechanism. The mechanism is not a conspiracy. It's the ordinary mathematics of leveraged markets under changing requirements. Imagine a crowded theater. The doors are wide open on the way in because everyone enters calmly. Now imagine someone turns the lights off and narrows the exit to a single doorway. It doesn't matter how confident the audience feels about the show. The flow becomes disorderly because the capacity has changed. In futures markets, the doorway is margin. When margin requirements rise, capacity shrinks. Participants who are comfortable holding positions must find more cash, reduce size, or exit. In calm conditions, that adjustment can be orderly. In a volatility spike, it becomes abrupt. And abrupt adjustments create price gaps, which create more margin calls, which force more selling. That's the cascade. Now add modern speed. Risk systems reevaluate exposure continuously. If volatility expands, internal models tighten limits. Dealers widen spreads. Liquidity that looks deep at 10 cents of volatility looks shallow at $10 of volatility. The same market, different regime. This is the part no one is discussing. Volatility is not just a measure. In moments like this, volatility is the instrument that governs behavior. It dictates collateral, it dictates liquidity, and it dictates who can stay in the game. So what does this mean going forward, without pretending to forecast a single price target? Historically, when a market prints a record range, it experiences forced deleveraging and shows split. Signals between flows and price, one of three paths tends to follow. Scenario 1 is compression. The market absorbs the shock, volatility collapses, and price grinds into a new range as leverage resets. In this outcome, the important signal is stability in collateral demands and a cooling of intraday swings. Scenario 2 is a second leg liquidation. This happens when the first crash was the initial flush, but subsequent margin changes, risk reductions, or funding stress produce another wave of forced exits. In this outcome, the market can revisit lows not because fundamentals changed, but because positioning had not fully normalized. Scenario 3 is a violent repricing once liquidity returns. After deleveraging clears, price can rebound sharply because the pressure of forced selling disappears, and any underlying demand, industrial investment, or hedging can express itself without being drowned by liquidation flow. The right question is what to watch that differentiates them, and the indicators are not social media opinions. They are collateral, positioning, and delivery stress. Watch how exchanges treat margin over the coming sessions. Does the system continue to tighten or does it stabilize? Watch how volatility behaves. Does the daily range compress or does it remain extreme? Watch how positioning evolves. Do speculative net positions expand again or does the market stay cautious? Watch for signs that paper pricing and physical sourcing are converging rather than diverging. Because the deeper message of this event is not silver is up or silver is down. The deeper message is that the market has entered a regime where small changes in rules can trigger huge changes in outcomes. That is what violent volatility really is. Not a random storm, but a structural shift in how risk is priced. And now we arrive at the divide. The people who get hurt in episodes like this are not necessarily the least intelligent. They are often the most narrative-driven. They believe a story about what should happen, and they ignore what the system is doing. The people who survive are not necessarily the most confident. They are the most attentive to the machinery. Information gap becomes wealth gap because institutions act on mechanics first and explanations second. They adjust collateral, reduce exposure, widen spreads, and move size. Retail attention arrives later when the chart looks dramatic and the story feels urgent. That time difference is everything. January 30th, 2026 was not just a wild day on a price chart. It was a demonstration of how quickly a leveraged market can turn when collateral rules tighten and liquidity thins. A 27% collapse in a single session, a margin hike to 15%, hundreds of millions flooding into an ETF, a bearish position monetized across the Pacific, and a physical vault statistic that barely budged. These are not random facts. Together, they describe a system under strain. This is channel name, where we decode what matters before its headlines. If this connected dots you hadn't seen lined up in one place, you know what to do. And remember, the question isn't whether volatility returns. The question is whether the next move is understood as a story or recognized as structure before the market forces everyone to learn it the hard way.